If you are in the market to ever get your significant other the real thing rather than the costume jewelry, for which I have been famous for decades with my wife, your ship has come in. Gold prices are tumbling. They're at 5-year lows. Larry Glazer, what's going on here?
Can I just say it is always a good investment to buy your significant other jewelry around special occasions.
Well,
that's
yeah,
the best
costume or
investment
otherwise.
you can
Yes,
make.
indeed. Well said. What is happening here, though? I don't understand this rapid descent.
Sure. Historically, gold has held a safe haven status. It's almost an insurance policy for many investors. But like all insurance policies, you hope you don't need them. You hope you, in effect, lose money on that insurance policy. And that's exactly what's happening right now. You know, biggest seller of gold overnight we saw was China. So clearly, China, one of the largest buyers of gold, is pulling back the reins. They're not buying as much as we had hoped. So that's a big factor here. Also, the weakness in the Chinese stock market is causing turmoil in their economy. It's causing people to raise money. What do you sell? You sell the gold. So that's a big factor. But it's not the only factor, Neil. Better U.S. economic data and a stronger dollar is also contributing to the weakness in gold. Look, Armageddon is not upon us today anyway in the U.S. economy, so less of a reason to buy gold. And then finally, the Fed has signaled their intent to raise rates. So many people buy gold as a safe haven against inflation. Well, with the Fed raising rates, taking action, inflation again is not upon us today anyway. So all those are contributing to a rapid weakness in gold, along with other commodity prices, I might add.
You know, you could argue with the St. Louis Fed president telling our Peter Barnes that there's a better than 50% possibility rates go up in September, that, you know, there has been a case where the Fed has fallen behind the curve, a great environment for gold. So you obviously do not think that's the case here.
Well, I think it's a great first step that the Fed is certainly taking action. And, you know, it's creating turmoil, certainly in the currency world and in the bond world. And we may see that spill over into the equity markets. It certainly could have an impact on earnings in the U.S., and we're right in the middle of earnings season right now. But I think as it relates to gold, you know, commodities are the definition of a cyclical investment. So if you want to buy them, whether it's gold or oil or silver, industrial metals like copper, you buy them when they're out of favor. And when China, the big buyer of these things, isn't buying, that's when these metals fall out of favor. So there's certainly margin selling, forced liquidations, all those create a better buying opportunity. The question is, can you stomach the ride? And I think that's really the message here. For many investors, if you're going to own it the right way, and it doesn't come with a user manual, is own it as an insurance policy, own a small amount, and it's a hedge against some of these other things that are not upon us today, but they could show up in the future.
Would you own gold
and then you'll be glad you
stocks
bought
as a proxy, or are you talking the metal itself?
Sure. Well, I think you can buy the ETF certainly today. That is the least expensive, most liquid, cost-effective way to do it. But gold miners are certainly out of favor. They do track the underlying metal, and that's an opportunity for investors to look at something that's truly out of favor in a very expensive stock market otherwise.
Larry, always good chatting, my friend. Larry Glazer.